Okay, welcome back, everybody. And for today, I am going to do a workshop on building a portfolio. Of course, this is the way I would build one. Everyone likes to build them a little bit different. But I'm going to go ahead and start with showing you how I start my process, which essentially is looking for companies that have reported um, better than expected revenues and earnings per share. So here on my screen, I have, I'm over at Zacks. This is where I start. And I pulled up July 25th. I'm going to just give you an example of a stock that did come in and report better than expected numbers. You can see down here, one of my favorites, Starbucks. Easily beat expectations, 6.823 billion in revenues. Market was only expecting 6.685 billion. So an easy beat on the top line. And if I go over to the earnings surprise and also break this out and scroll down, you will see that Starbucks is on the list, 78 cents versus 72. Now, for me, I guess because I'm a CPA, I just feel like I am much, I don't know, I trust companies a lot more when they're beating top and bottom lines, because really the only thing that Wall Street has to go on until they get their hands on these actual reports is what management tells them. They raise and lower their estimates based on meetings that they have with the company, based on how optimistic they are, based on maybe their competitors, how they're doing relative to their competitors. If they've got new products, they're looking at the acceptance of those new products. And then they're constantly looking at their earnings estimates and either revising them up or down. And so there's a lot to be said for the credibility of management and whether or not these companies, when they tell Wall Street that they're going to do something, whether or not they follow through. And I just have a very tight leash in terms of fundamentals. I just don't want to deal with companies that do not, where management teams, I'm not going to say mislead, but just simply miss their numbers. If they're, to me, it's a promise. That's what they're making a promise to Wall Street, that these are the numbers they're going to hit. And when they don't hit them, I think it can have some very negative ramifications, not only in terms of short-term price action, but long-term trust in a management team. So that's just my personal preference. I like to trade only companies that beat top and bottom line. And some will say, well, what if they just match? Well, that's fine. They did match, but I prefer beating. I think beating is better than matching. I think it tells you that the management team's conservative. You also have to wonder if they just matched. Did they, was there some kind of rounding or something that took place to get them, make sure they could get that number? I don't know. I just prefer seeing the beats on the top and bottom line. So that's the first thing I do is I go through all of these earnings reports, and you can see on July 25th, there were a bunch of them. 166 companies reported earnings per share that exceeded their estimate. And when we looked at the sales number, and I can't quite explain why, but Zacks will truncate, meaning they won't go all the way through the alphabet. It usually stops in the S's for some reason, right there. So I end up having to do a little bit more work on the companies that reported earnings per share better than expected that start with T. I have to go to other websites. I'll use Benzinga. I'll use, just Yahoo Finance. I'll Google, try to find information. It leads to a lot more research time on my part, but it's what I have to do. So I go through the entire earnings season and essentially put together what I call my strong earnings chart list. And so if you look over here, right here, I've got a strong earnings. This will be updated. Probably another 200 companies will be added to this. But right now, where it stands is I have, I think, 137 stocks on here. And here they are. I could put them in numerical order, which is just chronological. So this is the company DY, was a company that reported probably a couple months ago, and all the way down to the last one on the list here, which is WIX, which probably reported about 2 weeks ago, because I haven't updated this over the past 2 weeks. But I can quickly see all the companies in here, and if there's a particular industry group that I'm interested in, I could just type it in, banks, and then quickly identify the banks. I could do the scooter and identify which banks I think are the strongest based on the scooter. Then I can pull a chart up quickly and take a look. So if banks was an area I was interested in, that's how quickly I could come through and find out whether or not this is a stock that I would be interested in. Now, Ally actually did make a breakout above 30, maybe 29 and change. So I think as long as we're down, I would be accumulating probably at these two levels around that 50-day, but I probably have a stop in maybe about 29.50. But that would just be a quick way of starting with banks and zeroing in on a bank that I liked. If you want, maybe only large cap, you can add that right here, and you can see that the large cap, the highest scooter rank is USB. It's a little bit misleading because remember, the banks have been under a lot of pressure, and especially with falling treasury yields. So when they're measured, they're not measured against their banking peers. They're measured against, large caps are measured against other large cap stocks. So they're being measured against large cap software, large cap restaurants, large cap specialized consumer services, areas where the market's been really strong. So sometimes when you look at those scooter scores, you have to keep in mind what area of the market that you're in. When you're in banks, maybe a 50 or 60 scooter rank is not going to be that bad. You can see some of these other banks are much lower, even though they've recently beaten top and bottom lines. Every one of these companies have beaten top and bottom lines. All right, so this is the first step for me, is putting together this strong earnings chart list and then being able to go through and find which stocks within certain groups that I want to include in my portfolio. So that begs the question, okay, I've got 130 stocks, soon to be probably 300 stocks on this list. I can't buy 300 stocks in my portfolio. I wish I could, but I can't. So how do I lower that number? Well, I look at this every quarter, and I've talked about it on here. I've written about it a lot. I have 3 portfolios, a model portfolio, an aggressive portfolio, and an income portfolio. So the next step really after building this chart list is simply determining what my risk profile is and what's the risk of being in some of these individual stocks. For instance, there are some of you maybe that are retired, living on fixed income, and probably are not in a position to take a chance on a stock like Digital Turbine, which has been going up beautifully, but it's built on a lot of growth prospects and a lot of promises. And if those promises fail, or if the company were to come out with a warning, this is the type of company that could easily lose 20, 30% in a day. You're on fixed income. This is not exactly the kind of stock that you really want to be looking at. In terms of software, if I was on fixed income, I'd be more interested in a company like Microsoft, where they do pay a dividend. Their growth, even though they've had a tremendous year, is a little bit more predictable. The company is very well established. It is a leader among the software groups. So again, finding the individual areas is one part of the equation, but finding a stock that fits your risk profile, I think, is really important as well. Don't go out there and get a bunch of 10 high flyers if you really need your capital. If the capital is the name of the game, and you just want to have maybe a little income, a little capital appreciation, there are alternatives for getting involved in some of the areas of the market besides going with the high growth, high risk. All right, so let's talk a little bit about strongest sectors and strongest groups. And I've got on here, I keep relative strength chart lists. One is on the sectors. So here's technology, for instance, versus the S&P 500. A lot of folks want to say that this weakness is leading to a bear market. I do not agree with it. I think that's an opportunity. I think we could go lower. I think that the S&P 500 potentially could be in for a 10% correction. I don't know if we're going to get that, but I wouldn't be surprised. But normally when you start a bear market, or at the beginning of a bear market, leading into a bear market, you start to see these aggressive groups relative to the S&P 500 begin to fall apart. Technology in 2019 has been straight up. We had weakness back in April and May, but that's all it was. It was weakness. And then immediately when the market started moving higher, technology led again. So we're running into some weakness. So we've pulled back. Now today we're getting a move up. Technology's leading again. That is not the way bear markets develop. Bear markets develop when we start to have a bounce. The relative strength of technology continues to go lower. We start getting a bounce because of money rotating into defense. That is not what we're seeing here. It's not what we saw back in May. And of course, this is just one group. We go into consumer discretionary. There's still an uptrend in play here. Have we weakened? Yes, we've definitely weakened. 1 month ago, we were at an all-time high, consumer discretionary versus the S&P 500. So I think that this overall looks pretty good. We could go down the list. These are the two strongest, by the way, in the aggressive areas. But the others aren't bad. They still have an overall long-term uptrend in play, in my opinion. So then once we know that the sectors are pretty strong, then the question is, okay, well, where do we go in terms of industry groups? Now, I do know that one article I'm going to point you to, yesterday we had John Hopkins on, and in his Chart Watchers article, he wrote about the 5 best industry groups, not named software. Well, I'm going to tell you, software is one that I would continue to have on my list. But he went through and we went over this article a little bit: specialized consumer services, consumer finance, restaurants, specialty finance, and then renewable energy. And these are the relative strength of these industry groups versus the S&P 500. If you want to outperform the S&P 500, it's really important to be in groups like this that are outperforming the S&P 500. So renewable energy is one that I think should be considered, but renewable energy is extremely aggressive. So again, getting back to that risk profile, are you somebody willing to take that risk? If you've got an account, I'm not going to call it play money, but if it didn't ruin your life, if you lost money and you're willing to take risk because you want to try to outperform the S&P 500, renewable energy makes sense. Likewise, specialty finance, beautiful move up in specialty finance relative to the S&P 500 since the lows that were established back in October of last year. Then you've got restaurants and bars. Look at the relative strength here over the last 30 to 45 days. It's been off the charts on the restaurant group. Consumer finance, you can see also very strong relative to the S&P 500, and then there's your specialized consumer services. So these are the groups, and you might say, well, they've gone up too much. Well, we could have been saying that for the last 8 months. The point is, once they start to turn back, they break trend lines, they break out in terms of absolute strength, they break out in terms of relative strength. These are the types of stocks or areas of the market that you want to be involved in. Another one, actually, I'll go back over here to this chart. Let's pull up in the industrials, a group that I've talked about a lot, defense. And this was a perfect example. I mean, I've been talking about this for the last 3 months. Here was where we broke the downtrend line on the absolute chart back in April, May. And look at what we did here in terms of relative strength. We put in a double bottom and we took out this high, breaking through that 50-week moving average. So now all of a sudden we're trending higher. The 20 goes through the 50, and look at the PPO, the relative PPO. And that's important. That's relative PPO. So now the momentum of defense versus the S&P 500 is clearly positive and pointing up. So I'm going to want to have defense stocks in my portfolio or portfolios. The type of defense stock, though, again, comes down to what type of risk are you willing to take. All right, so we've talked about some of these stronger industry groups, and there are others. This is, again, I have this chart list set up where I have every single one. I could tell you that, for instance, waste and disposal services has been very strong. If you're somebody who is more of an income-oriented investor, you like dividends and so forth. What about a company like Waste Management? Waste Management's on my strong earnings chart list. And if we look at a relative chart of Waste Management, it's been trending higher. Here's the group, been trending higher. Waste Management's been one of the best performers within the group. Just broke out again versus the S&P 500, and the group just broke out versus the S&P 500. So if you're building an income-oriented portfolio, Waste Management looks like a really nice potential trade. And this is in my income portfolio currently. It's been a really nice performer. Has it been shooting up? Is it up 100% the last 3 months? Of course not. But also when the market pulls back, when it pulled back in May, you had hardly any deterioration to the downside. When we had the new low on the S&P 500 back in December, Waste Management held that prior low. When we had the big sell-off recently, you can see we pulled back on Waste Management, but quickly moved right back up to a 52-week and I believe all-time high. So there are, again, different strategies for different investors in terms of building a portfolio. But Waste Management would be a more conservative way to trade a group that's been performing exceptionally well. All right, we talked about software a little bit. Let me go over here and show you the software chart. All right, so in software, I mean, wouldn't you want to be part of this? 2 years, going on 3 years and counting, where software has essentially just been going straight up relative to the S&P 500. I mean, if we said, well, it's gone up too much back in May of 2017, we would have missed the last 2 years. And I'm not saying every group goes through this kind of an uptrend on a relative basis. But my point is, as long as it remains healthy, and by healthy, the 20 weeks above the 50, the relative price is above the 20-day or 20-week, and the relative PPO has never been negative. That is the definition of a very strong group. So, of course, until that breaks down, you want to have representation there. That's how you outperform. Now, if you're a value investor, then you can go look for some of the dogs in the market. That's not what I do. That's a completely different strategy. It works for some. It doesn't work for me. I'm trying to continually outperform the S&P 500. I don't want to buy into value stocks and wait 3 years for the market to agree with me. I want that instant gratification each quarter of going with the best stocks in the best areas of the market. So there's your software. So what do you do with this? Well, again, if I go into my strong earnings chart list, and I just go in here and hit the summary. All right, so software is a group I like. Well, I'm going to have a lot to choose from here because software has been awesome in terms of beating estimates. Now, remember, I only have 137 stocks on this list right now, but probably 20, 25 of them are software stocks. They have been on fire. You can see many of them in the 90s in terms of scooter. Some of them are large cap, some mid cap, some small cap. So if you're somebody who's very aggressive, I showed you this one earlier, but Digital Turbine, huge move up. This was actually a setup that I had back on July 22nd when it hit I think it was around 480, 485. I actually traded it and got out around 5.25. Got out a little early, I'd say. But the stock has continued to perform well. We've gotten a breakout, and I don't know how far it's going to go. But what I can say is that normally when these stocks get in these uptrends and you see this kind of volume coming in, there's accumulation. So yes, you'll get a pullback, but as soon as the market starts to strengthen, money will rotate, typically will rotate back into a stock like this. So what are some others? Well, we've got, I know this was a setup that Aaron had at one point, Manhattan Associates. Huge move up, mark the support level. Here's a perfect example. Stock pulls back right into this zone, upper 70s, and literally within 2 weeks, market rebounds and Manhattan Associates comes right back into favor. Look at the volume coming in. Software, relative to software, just set a new relative high. This is a great looking stock to me. Probably, maybe we'll see a little consolidation, but I expect our next move, big move, will be to the upside. All right, let's see. Talked about Microsoft, so no reason to bring that one up. Now, one stock that's not on this list because it's getting ready to be added is AYX. They just came out and blew away their earnings. So if I come over here and type in AYX, you can see huge volume. Look at the stock continuing. It's trying to set a new high today on the close, 133. Look at the relative strength. AYX, another great performer. All right, let's move on to back to the strong industries. Let's look at, we looked at defense. Renewable energy I've talked about. Let's talk about restaurants. Here is your 3-year weekly. Now, again, not really doing a whole lot for a while. Makes a big relative breakout, though, here at the end of last year. And you can see it coincided with a breakout in price. When you see that happen, just like I explained with defense stocks, that's a good time to begin thinking about adding stocks into that area. Restaurants have been one of the best performing areas in the market in 2019. And on a relative basis, they've been exploding to the upside. So what do? Well, we come over here to type in our restaurants. And right now, CMG is the only one listed in here. But keep in mind, Starbucks will be added. I know Shake Shack's going to be added. That's on my list. There's probably a couple of others. But pull up CMG. This has been in my model portfolio for 2 straight quarters. Look at what it's doing. The market's been very weak. CMG just keeps going up. On a relative basis, I mean, look at the strength in this stock. Why wouldn't you want to have a stock like this in your portfolio? Volume trends remain strong. I think Chipotle looks really good. So then once you go through and you decide, okay, I'm going to be risky, I'm going to be safer, whatever it is, you find your key areas of the market that you want to have representation in. I go into my strong earnings chart list, I type in the industry group, all the stocks come up, and then I can go through their charts and pretty quickly identify stocks that I want to be in. Now, all of that starts with a lot of homework. And a lot of this, as you can see, is based on relative strength. The one thing I would ask that you consider doing, if you haven't already, is there is a free newsletter over at Earnings Beats. And if you go into earningsbeats.com and click on free newsletter, just type in your name, email address, and subscribe. Completely 100% free. And it comes out 3 times a week, and it's focusing on exactly what I just went over. Earnings, relative strength. Can't tell you any more than that. I mean, it's worked for me. It's certainly been working for earningsbeats.com members. The portfolio performances have been off the charts relative to the S&P 500, and I think you ought to think about checking it out. All right, let's go ahead and pull up the summary, and you can see it on your screen, some of the things that I talked about and some of the things that I certainly would be considering if I was beginning to build a portfolio. So check that out.